So I will start with the classic valuation method, because I'm not sure if everyone in the class has previously raised his funds or had the opportunity to sit with an investor and definitely evaluate a business. So at a classic level, the valuation methods reflect three major principle, which is one based on the cost approach, which is the investment and the cost made to build a business. The other one, which is one of the most useful and used in the right market, especially for startup and innovative business, is the market approach on the relative value, where you get these ratios. So basically, you get a multiple on similar company sectors and things like that, and you find your space. And the other one, as we mentioned the other time, is the discount cash flow on an intrinsic value approach. We have to say that it's hard to say if there is a correct method, but sometimes you have to do at least two methods and get an average valuation. So the comparable analysis, which is one of the most used right now, just take three major multiples, which are the earnings, the revenue, and the EBITDA. So usually you take similar companies or sectors. Sometimes they are listed, or they comes from previous transactions like on M&A or other VC rounds, and you take those projected revenue, and you get your number. We will get into this number just later on the financial model. The other one is the precedent transactions. So when a business is clearly established and we are on the merger and acquisition phases, where you try to figure out the right evaluation. So you see if a company in the same sector on the same space that you are got acquired for an amount based on sales or EBITDA. So you take your numbers, and that's how you came out with your valuation. And the last one, but it's the most used in order to evaluate a business, is getting your inputs, as we saw the other time. So you comes with the revenue, the income statement, balance sheet, and cash flow. So you take a 5-year cash flow, and you actualize those numbers at the year 0. And at that time, you get free cash flow unleveraged, and that's how you came out with your valuation. So this is quite easy method, and at the same time, it's used. And the last one is the venture capital method. So the venture capital method, somehow it's quite similar to the multiples, because you take your investment needed. Let's say you want to raise 1 million. You do your forecast. So you do your projection in terms of revenue, EBITDA, and earnings. You made an average at year 5 of those projection, or year 5, or whatever you are projecting your exit. You calculate your multiple. So let's say at the year 5, you are making 10 million in revenue, and we are applying 10 times, and the company is valued 100 millions. So let's say, of course, you discount to the present value at the designated rate of return. So let's say 30%, for example, and that's how you determine your valuation and how stakes you wanna sell. Of course, this is very used in the States, but at the same time, it's sometimes it's hard to predict, on year 5 how much the company scale. But it is quite easy to see comparable comparable phase. So we jump directly on a sample of a financial model, so we can probably interact more. So usually how we work on the financial model, but this is also a suggestion that I give you, is to separate the input from output, where you have different colors. For example, usually I use, and also on the company I work with, we use the blue for the input, so we know what kind of cells we can edit and modify in each sheet, and the other one will never be touched, so the other cells comes as outputs. So in this case, we have an exchange where you can see how we develop and build the inputs. So for example, the number of sales based on quarter or per year. And we have an amount of users, and at the same time, the business model comes from the sales and the subscription fee. And so how we comes with the revenue, and same thing in the cost, which is the inputs come directly in the cost sheet here. So we apply in this model, as we discussed the other lesson, also charts and graphs, because it becomes more visual. So for example, let's see, here we want to edit something. It changed immediately the business model, the financial models, the charts, and everything. So for example, let's see here, we want to do this, and it changed everything. Just like I was. So in this case, also we create here, because it is a digital business, a resume where we have all the revenues and the cost, and the net income. All the other Google Sheets here comes from to help in the budgeting area. So for example, if we want to be very in deep in terms of details for the different revenues, the staff, so how many people needs to be hired, when, and the cost. Also, as mentioned before, all the cells in blue, they are you can edit those ones. Then we have the other cost. Dilution calculator, as we saw the other time, the cap table is something super important to see how the in case of an investor comes. So let's say it's split on here 0, here 1, here 2, company formation, seed round 2, and Series A. So every on every stage, the cap table clearly changes. So we need to see exactly how our percentage at the end of the journey. So this comes with the exact latest that we discussed before. So let's say in this case we want to evaluate a business, and from these inputs we comes with different revenues that are exactly here, and we comes with these revenues that we report here. We report as well the EBITDA and the net income, which are the three major inputs we need for the multiples, and we apply a ratio based on the sector. Every sector has its own ratio, but usually on the innovative sector, it's quite easy to find based on listing company or present transaction, as mentioned, and we multiply the ratios for the revenue and EBITDA and net income on each phase. At the same time here, there is an hypothesis to raise 2 million. So what happened? So basically, this part of the Google sheet reflects the return on equity and the ERR. So working on a VC perspective or investor perspective, how much my my investment turn on each year in case of a liquidation event. So in this case, if we plan to raise 2 million on a giving out 20%, and let's say in 2 years, in year 2, we have let's say the company will be acquired. What's the potential price of acquisition? It's just here because it reflects potential multiples based on the scenario we made on revenue, EBITDA, and net income, and we multiply that, and we have our return, the investor return and the internal rate of return. So basically the percentage on the investment made. So this comes here every year just to see if the investment is right on based on the projection. This is one of the first method I definitely suggest. The other one, as we planned before, is the discount cash flow. The discount cash flow, it's quite easy in terms of creating the free cash flow, which comes right, in this case, right here, because the company has the net income equal free cash flow. So you count revenue, EBITDA, and free cash flow.
If I don't distract you while you're trying to fix it, I have a question with respect to the previous model. When you're calculating the ROI from the investor's perspective, you're assuming that you're assuming that you're giving up 20% equity at the current round, but you're not projecting other rounds that might happen in the next years, because you're projecting the impact of giving up 20% or vice versa from the investor's perspective of acquiring 20%, and then you're projecting the ROI in year 1, 2, 3, 4, 5. But what happens if there is another fundraise after a year or 2? Are you taking that into account and projecting that too?
No, you're not projecting at the beginning, because this is more a static approach where you can see the investment, the change, and it basically see what kind of multiples it applies for every company.
Okay, I see. But I guess maybe an advice might be, take that into account because this is related to something that I always recommend, which is when you're structuring today's round, always take into account the expected rounds that you're going to have in the future, because there is a correlation, right? It's like saying if you give up too much equity now, you're not going to have enough equity to then support the next rounds, and you might just run out of gas, or vice versa, right? If you don't raise enough cash now, you're not gonna make it until you have something to show for the next round. So it was just because again, like a lot of companies are currently structuring the round, and I think it's important for them to understand that when they come out with an investment strategy, it's not just the strategy of the current round. They need to,
of course,
try at least to project it, even if a lot of things can change. They need to project when the next round is gonna come, so that they can, structure the current round accordingly.
So my contribute on that, because I agree what you say, is that you combine your dilution calculator here, because here basically, let's say you want to project several rounds, okay, let's say 3 or 4, and perfectly all the investors that comes, the founders, the equity pool for the key employers, and everyone. So how the valuation change, and you can combine, let's say in few rounds just made 2 or 3 scenario here. The only problem is that, let's say there is maybe I don't know, the company doesn't achieve anything on here too, so the valuation is less than that. So that's why probably in this case a static approach it's easier, but consider that it is that this number reflects the valuation that we are giving in a moment on a discount cash flow, because we need to see before the discount cash flow, so the potential free cash and how we are discounting that and the value of the business. And after that, we come here and we see, all right, with that valuation, I want to raise 2 million for 20%. But in that case, so on here 0. So right now, if I'm investing with that side, with that ownership, what happened on here 3 with my investment? I did 47 times, 47.8 times. So that's you combine to approach the first one with the projecting cash flow, because we assume that the company grow and make money, make cash flow, and the other one with the comparable. So the venture capital understand exactly the potential and the scalability of the business. So as mentioned before, what happened is that we have this free cash flow here, and we discount if there is a terminal value of a net present value, and if we want to see what kind of terminal value is here, we project the revenue for a multiple, and at the same time the biggest ration parameters are here. So we have the risk-free rate, the beta, the equity risk premium, and the illiquidity premium, which comes from as a discount rate total. This is totally, let's say, negotiable. So if there is there's not like let's say a strict or sure rules on that, but it's a point of discussion and negotiation with the potential investors. So as long as clearly the valuation, because thinking this way, every innovative and digital business, especially in the blockchain space where it's so disruptive, we project crazy revenue on year 5. So if you think about, you project, let's say 300, 400 million on year 5, and right now with just a project, if you want to discount that value, even if you apply a very small numbers in terms of comparable the venture capital method, you comes with a impressive valuation. So you definitely need to find your space between that. So my final, let's say, suggestion on this is, first of all, if there are so many let's say range of valuation that you can find and read everywhere, so on, let's say Big Four reports and things like that, where you see exactly a new startup with a revenue or with a small revenue or whatever, if they need to raise funds. So you exactly need a range. So you know, for example, that it's quite impossible to find 100 million startups with just an idea, but it's probably much possible with a valuation of 10 million. So that's probably one of the starting point. Right after that, you take your free cash flow, you project that, you discount, you have the first idea, you comes with the how much equity you want to sell at this phase, and you figure out exactly the return for the investor. So this is, I think, in my personal opinion, the easiest part on the valuation side. I'm not sure if we want to cover something specific, or for example, made some something on tokenomics, or how if you guys are thinking or between on high CO and a private round, so how works in the case. So in case I want to do a private round as well, but they enter before, so they got discount, they got conversion, or whatever you guys prefer.
Unless you guys have specific questions, I think that what you just mentioned, Giovanni, is very relevant. I know that there are questions around that, and I see that Paco has some issues, so he's not joining or hasn't joined yet. But what you just
Yeah,
said,
a couple. I'll jump in, Lorenzo, if that's okay. There aren't many comps out there with early stage company. Giovanni, of course, is always in the blockchain space, and it's really interesting to see where all that's going from a valuation standpoint. OpenSea just raised 300 million at a 13 billion valuation. That's pretty good for an NFT marketplace. So that's pretty
Huge.
easy to see. Yeah. But these early stage companies, it's been interesting as we've looked at it. Having been in prior deals in prior industries from years ago, it's so arbitrary to determine equity valuation. But it's been in our token raise, and Doug and I'm with Vendible, we're raising money. It seems like it's been, from a valuation standpoint, just kind of cleaner and a little bit easier in the valuations, because we've set our valuations at the seed level, the private round level, and then once you do a public event, a Genesis event, we've kind of set those. And yes, they're arbitrary, but a lot of the investors that we've talked to haven't really pushed back at our numbers. And generally in the old days, it's like, well, how do you come up with that valuation? Show me your numbers, show me your projections. We've done all that, but with our valuation set at the number of tokens at a certain price, here's the valuation, here's our total supply. It's been a pretty seamless process, and I hope that just continues as we raise more money and get more revenue traction. But I guess really just more of an observation on the token offering side, because those valuations are kind of almost preset.
Yeah, that is true, but at the same time, think that not every, let's say, VC or investors, even if they are looking for, I mean, ranging in the blockchain area, they are looking for tokens. So they need to justify somehow the numbers, because they are, let's say, in that, if they do equity, it's more traditional finance approach. But I totally agree with you that with the tokenomics part, it's more it's kind of more cleaner, because you have different phases, and if you don't get on each phase, you are now moving away. So that's agreeable. The other part, thing that we saw, it's so new. This is probably also one of the thing that if you take I don't know, the other day we saw Microsoft acquire Blizzard, Game Vision Blizzard. They apply classic methods, of course. 68 billion. It's so easy. You can see the revenue and what kind of multiple they apply. That's it, because it's a traditional, and of course there will be, I'm sure, 10 analysts working on different scenario models, discounts, and that. But at the end of the day, it's kind of scientist methods that it's in place since probably 100 years and teaching university, while these new methods are coming here by here. As you mentioned before, OpenSea, it's such a great example, because it's super new and they raise so much money, and that probably at the early stage was unexpected. And in my opinion, it's because there's so much liquidity on the crypto space or crypto related space that need to justify those multiples, because there is no other thing, because they will never look at this return. Like usually a VC looks for return on equity after year 5. They're just looking for invest now and get out maybe after the lockup period in 24 months, and they want to see only the return and the growth of the tokens. And the tokens, it's quite easy to predict in terms of release year by year, or the burning part or the milestones. So that's why it comes cleaner. But the fact is, are there
going to be other sort of metrics that people are going to be looking at? It's just curious to see. Is it going to be like are your valuation is going to be a multiple of sales? Are they going to be a multiple of EBITDA? Or are they going to be like based on the number of community users you have? Are there going to be some
totally on community, on community, because if you think about the equity side, will never get to the same growth and justification of the token one. So it's totally on the community part.
Yeah. So are you saying that our investors will be happy if we show monthly traction with building our Discord and our Twitter accounts, that they should be happy even though we don't have any revenues?
Well, that's what is happening. That's what is happening. Yeah. So let's say if we regarding traditional crypto related fund, traditional in terms of the new ones, or this one that want to see they're looking for the company grow, but they want to see all the tokenomics parts. Yes, all community based, and that's the biggest part, because the community based is related to the adoption of the token. As long as the community grows, of course the token it's usable inside the project or the company. So that's important. Yes, the major traction it's coming only on that, and it's coming also regarding OpenSea, because I read a few articles the other week. It's related to the speed of the growth. That's also another important metrics to consider on an equity round like that.
Will there be a day where we value the company based on a multiple of how many community members we have?
No,
I'm kidding. That's kind of random, but
no. But that's true. That's what we are discussing. So that's absolutely true. I think so let's say in this way. On one hand, yes, it is based on the adoption of the community, how many people will use your services, products, whatever. And the other hand, there's a company behind, so they need to see the real metrics at some point. But if we check most of crypto, even the layer 1, etc., you will be surprised how much the market cap of the tokens and how much revenue they made. I'm not sure if someone has ever read, but it's unreal. Like there are some layer 1 that do 20 million revenue and they market cap 7 billions. Like this cannot happen. This cannot happen. Like let's say even on a tech bubble. So the only thing is based on the community, because the expectation on the revenue growth, it's related straight to the adoption. So as long as the tokens trade, so people there's a large community, and the expectation on year 5 on the revenue is based on the community. So if you think about at the year 0, you have no real metrics, but you have your community, and that community, it's made the projection on year 3, year 5 on the revenue. So you need to have both. This is my reading.
Yeah, and I guess it just depends on how well you know people and your relationships, which we're really big on relationships at Venable. Like, did you guys see where Benedetto Biondi at Folks Finance? He just raised $3 million from Borderless in a group of about, I don't know, probably 20 companies. But I wonder, and maybe I'll ask him, but I wonder like what his valuation is. I think that was in a token thing. That was not equity, but getting a list of those companies like that would be interesting. Algo, Mint, others, just to see what their, how they're positioned and what their valuations. It'll just be interesting study to see how those are progressing.
Yeah, also because you touch a good point. Also because getting on such a new sector and on a booming also sector, it's every business model. Not every, but there are lots of completely new business models. So there are no like precedent transaction. So it's something based also on the relation and how the fund is investing, is projecting the growth, because it's with this token part, it's completely related. It's totally related. So yes.
Mm-hmm. Yeah, no, that's good. Thank you.
Does anybody have more questions? Because otherwise, I will go back to something that Giovanni mentioned earlier. Should I? Yes? Okay. So you were talking, Giovanni, about making the decision, like evaluating different scenarios. We have now, in many cases, the opportunity to raise money through the ICO, which is something that clearly, unless you're in this space, it's not even an option. So on top of the traditional, fundraising mechanism, now we have the ICO. Can we maybe discuss some scenarios? Should we do a private fundraising round first to then prepare the ICO? How would that affect the cap table since we already onboarded private investors? Vice versa, when is it a better idea to go out with an ICO, assuming the company can afford it, because that takes money, right, to get to that point in which you're ready for an ICO. What if there are companies here in this cohort that are considering raising a bridge? So it's not a seed round, it's just getting enough money to be able to afford the ICO, to then potentially right after the ICO doing a proper seed round that has the advantage of showing potentially a successful ICO to investors, rather than raising the round before the ICO based on the promise that there's going to be a successful ICO. So I see like 3 potential scenarios: private round and then ICO, ICO and then private round, or a bridge to prepare for the ICO and then you finish the round, or you do a proper seed after. Can we maybe just elaborate a little bit on those scenarios?
Sure, of course. So I think first of all that we have to separate the token side to the business part, because they can be together, they can be separate in terms of raising also different targets, but at the end of the day, it's the business that is launching with an ICO the tokens to be used in the business. So if you think about the equity round needs to be considered. And you touch a good point, because in my personal point of view, the equity round is helpful to launch the ICO, because it gets you the cash and the money to do that. How usually the VC crypto related works is that they enter on so they get a valuation from you, so like a pitch deck, business plan, and a financial model like that, and they check you on your projection for the token for the ICO. So in the token allocation space, always you have to consider the private investors, which is the people that are bridging you to get the ICO. So that's the first things you have to cover. At the same time, consider that this works like more like a convertible in the traditional finance, so where they are not sure if they are doing debt financing or enter on equity. So let's say they want to enter in the seed round, and the seed round is for the ICO. They get a large or a big discount compared to that. So if you think about you on your token allocation part, you made a certain percentage for the private investors, assuming that everyone doing the public phase, because these are all the different phases. On the public phase, they convert, but they convert not at this discount or this price. For example, if we plan a fixed sale price, but they convert here. So when they take the risk. So this is, I think, to fully answer to Lorenzo's point, and the question was definitely to consider the equity round for the ICO. Because it's, I mean, there are some probably startups that can afford with the previous investment or whatever, but usually it's easier to get on board an investment equity round, and it gives you credibility, because it gives you credibility on the project if there is a fund like on board that believe and invest in the project. So when it got public, it's a reputational site where you can say and tell, so we are backed by these investors. So if they are behind us and they won't convert half part or whatever of the equity that they acquire, their interest is to take the token high. So this is something I suggest. That's why it's super important to raise capital with a fund that at some point needs to convert the tokens, because their intention is clearly to get the token listed and bring that token up. The other things to consider is super important is the lockup and vesting period, because this change on every phase. And just to remember that every investor that arrives, of course, he wants to sell the tokens right after he got click. But this is a big problem, because if everyone do that, of course, the price collapse immediately. So the point here is that we do the equity round, perfect. We deliver the ICO, so we do all the marketing, the technology development, everything. So we launch, we go public. They stay inside. Maybe a part can be sold immediately. That's okay. But the major part of the tokens needs to stay in hand of investor in every phase, like private one, private token, the community, and the public, because the price and the market making machine needs to be alive until 1 or 2 years. So there are multiple investors, and if let's say the first investor T0 sell his 3 million, it doesn't affect, because the company or the project it's valued 200 millions. But let's say if at the beginning it's valued, they acquired 3 million in token and they got public for 26 and they sell, of course it collapse. So this is a reading and very important things regarding how I think the companies are here and in the program that are structural. Why an equity round or why the ICO? I think both, because it's much important, if possible, to raise equity and cash to get a proper ICO.
Awesome. Very, very interesting. I'll pause in case somebody else have questions. Otherwise, I will keep asking questions.
Yeah, of course.
So we have an office hour focused on ICOs next week with Francesco, who is here today, and you already met him as an instructor. So I will make sure that all of the companies that are planning to run an ICO attend that session, so that it's more specific. But maybe, since I guess it's very related to my previous question as far as strategizing and also properly time uh, the fundraising, what are the things that should be taken in consideration before planning an ICO, right? So to get ready for an equity round, we somehow know it, we're familiar, right? So you need some validation, some traction, some KPIs, some financials, some projections, business model, and all of that. For the ICO, it's not necessarily like that. Of course, it's better if you have all of those things. It adds credibility. But we also saw a lot of projects that don't
We know
necessarily
that.
have that. And in some cases, some of those companies were surprisingly successful. I'm not recommending to do that. I think that we should focus on quality and not just on luck. But that being said, what are the key things? So, a couple of things that I have on top of my head. Liquidity, right? You cannot launch a successful ICO unless you have liquidity. You need to have, market makers. You have to have relationship with market makers. So what are these key ingredients so that we at least before making that decision, we have an idea of what it takes on one hand, the equity part, and the other hand, the token part.
Yeah. So in our specific case, I think the equity part, it doesn't need to be straight related to the to cash flow or things like that, because it's quite impossible to find on most of companies that are doing a seed round. So just consider that using probably the so think in this way. You need to raise money every time there is an event to scale or to plan something. An ICO, it's definitely an event and let's say an opportunity to raise capital. So we can say that because you're right that we saw so many projects that had no metrics, like no real metrics, and how it's possible that they got a successful ICO. The only answer is the adoption and how they are backed. So as mentioned before, if you're backed from a VC and a fund that has experience in the field, you will never fail on ICO because you get the right connection with the market maker, with all the attention and the other investors, because sometimes they act as a lead investor, so the first and the large investor in the rounds. And this is something definitely to consider. But the major metrics when you are planning an ICO, it's so I think the adoption and the speed in growth of the community, and that of course reflect after that the how the company basically grow, but at the same time how the liquidity inside the token market. So that's for sure the biggest thing everyone should focus right now, because right now I think most of you have a beta or just a launching service or product, so it needs to be implemented. That's why it's important to raise capital, and the only thing is see how many community you are already creating, because even if there are no paying user, you are creating a community, and that means that at some point they will buy your services, and if they buy your services, they are interested in the tokens. So that's a kind of a cycle, financial cycle, if you see in this way.
Awesome. Thank you. Anybody else? Does anybody want to share their current plans? Like, are you guys doing an equity round? Who is planning to do an ICO? Very shy. Usually, like, they usually jump on this, but all right. Okay. Anything else on your side, Giovanni, that you were planning to share?
Of course. I think I would like if, based on, of course, Lorenzo but I'm available if I don't know, everyone want like a review of his financial plan, or plan also some other activity in terms of a small lab to see financial models and things like that. And as well, we will upload the one sample, so in case they will be helpful for your raising.
Yeah, I think that
great.
Thank you very much.
Many had to leave, but I think it was actually interesting what you just said. So, okay, we can follow up offline.
Okay, perfect. Yes, I was just gonna say, I do have questions, Lorenzo, but unfortunately we have a meeting coming up in a few minutes, and I won't be able to, you know, sit around. But yeah, I'll take up on your offer. Thank you so much. It was a lot of information to you know, to process, and often power or something like that would be ideal. Thank you for the offer.
My pleasure. Yeah, looking forward to get your email or whatever, and we stay in touch.
Yeah, I'll make sure that you guys get connected.
Perfect.
All right, well then.
Thank you very much.
Thank you again. We're gonna share the recording and the presentation, and Giovanni's information. And again, appreciate it. Next week, again, remember, if you're planning to run an ICO, we have an office hour with Francesco, so make sure you take advantage of that opportunity as well. And that being said, thank you so much, everybody.
Thank you.
Thanks, guys.
Thank you.
Thank you, Giovanni.
Bye.
Ciao.
Thank you.